Hey there, it's Joshua Bellinger here at OptionSizzle.com, and in the next few minutes I'm going to answer a blog post or a comment to a blog post here from a reader. And for me, it's a little bit easier to explain this in a video because some of his questions will need a detailed response, and that's what I look to provide in this video. So let's go down to the article at the bottom here, and let's go through the question here. So the question I'm answering is right here, right in front of you, and I'm going to answer obviously the first question here. And the thing is that the article that I have in here, or what is above this comment, talks about the aspect of selling options. Now I have other articles on the website here, and if you scroll up and you look on the sidebar, you'll find one of the options here is buying options versus selling options, which is better. And in that article, I specifically talk about the outcome of selling options compared to buying options. And in short, when you sell an option, there is a probability of success of about 63%. And when you buy an option, we're looking at about a 33% chance of success. So when you're playing direction, you're better off actually buying stock because of how deltas work and how time decay of what this guy is exactly talking about here, unless you go out further in time and also go more in the money. What a lot of people do, and probably exactly this person's problem here, is that they're playing direction, and they're playing direction in a short amount of time, and a lot of decay happens within the last 45 days to expiration. So when you go out of the money and also you have less than 45 days, well, it's usually about 60 to 45 days where you really see a nice collapse. That's where I actually look to sell options, because I know that is what is going to occur. So when you go out of the money and you also have that short amount of time frame, that's where you see that collapse, and that is going against you. So when you're playing direction, meaning if you're playing a stock bias higher or lower, you ultimately want to go in the money a lot more, which would be about a 70 delta typically, and you want to make sure that you have enough time. The next question is even though 2 months out, I'm just scared and I sell early when dealing out of the money options. And that is really what's going to occur, is when you have that move and it doesn't happen right away, you have that decay, and a lot of times that move that you were expecting actually just gets your options back to break even, and that's where you exit. And that's why, again, if you're playing options for a shorter term or a directional trade, you want to make sure that you go into the money. It's about a 70 delta that you're going to look at. If anything, then use stock, because you have the nuances of options that go against you that really more benefit selling on that. Now, another thing here is, instead of playing those options, look to sell options. You can still sell options as a directional bias as well, which then increase the probabilities of success a lot more. If you're biased on a direction and you sell, let's say, the put because you think the stock or index is going higher, you sell that put and you have that chance of success even greater. You'll be on the opposite end, and even if the underlying doesn't move, you still benefit from that decay. That's the other aspect to be looking for as well. And the third question here is the delta does not seem to work, obviously, because IV movements regardless, because in the response to this, I can tell from how this person's explaining it, they really just understand kind of the basic of options, of just being a buyer of options, and the next development is to learn how to sell options to create those higher probabilities of success. Again, we've talked about this the last 4 minutes. When you go out of the money and you're in that short-term window, you're going to see theta decay against you. So it doesn't really mean anything on the delta moves. You can have a move higher, but a lot of people want to go out of the money. Options are already priced for that move to occur. You have to get that move fast and outside that expected move. Now, there's a few different ways that you can try to identify that, but you never know because you don't know what's going to happen. The market is random. The best way is to actually look on the other side and actually look to be a seller of options. That's going to create a lot more probabilities of success for you.